Hello and good morning. Welcome to our discussion on the cash flow statements. Today we'll continue our discussion on the determination of cash from operation when certain financial items or relevant financial items are given. So let us go to the Excel. So this is the relevant financial information picked up from the cash flow statement of an Indian company. And by using this information we will calculate cash from operation. But this relevant information, it's possible that all of them are not necessary for the calculation of CFO. Since the cash inflows and cash outflows are not given, we will use the indirect method of calculating CFO, and therefore we'll start with profit after tax. We know that CFO can be determined by making adjustments to the PAT, and the adjustments for the non-cash item, non-operating item, the non-operating expenses, non-operating incomes, and the changes in the working capital. Changes in the working capital. So let us find out these items from this relevant financial information and arrive at CFO. So the decrease in working capital or decrease in debtor is a change in working capital. So I'll just put that, and decrease in working capital means you are collecting money from the debtors, so it will be added to the PAT. Decrease in provision. Decrease in provision is a decrease in current liability and provision, and decrease in current liability, okay. Then decrease in capex. Capital expenditure is treated as the financing, not operating, but the investment decision. So that is not relevant for calculating the CFO. Depreciation. Depreciation is a non-cash item. Depreciation is a non-cash item, and depreciation has to be added back. Dividend received is an other income and is a non-operating income, so therefore that has to be deducted while computing the CFO. Exchange loss is a non-operating and non-cash, so therefore I put that in the non-cash here, because to that extent you have added in the income statement, so therefore I'm making adjustment in the CFO. Finance charge is another is interest, so it's a non-operating expense as per AS3. So finance charge we are adding back, and the finance charge is, though it is in the income statement, for the purpose of the CFO we will take this as the non-operating item. Increase in the current liability. Increase in the current liability means you are purchasing the goods on credit. So therefore, to that extent, it will be a surrogate for cash inflow, because it might have adjusted the COGS while determining the PAT. Interest received on the deposits. Interest received on the deposit is a non-operating and other income. So interest will be removed from the PAT. Okay, so interest is a non-operating item and it's an income, so I'm going to reduce or remove from the income statement. That means deduct from the PAT. Miscellaneous income, the same treatment. You have shown that in the income statement. Assuming that this is a non-operating, so the entire miscellaneous income has to be deducted while computing the CFO from the PAT. Purchase of shares for cash is a non-operating, is an investment decision, so not relevant for this particular question or discussion. Issue of shares to the employees is a financing decision, so therefore it will not affect the CFO calculation. Profit on sale of asset is also a non-operating and may be a part of the investment decision, but generally while computing the PAT you might have shown that, so therefore the profit on sale of asset has to be removed or deducted while computing the CFO from the PAT. If profit on sale of assets are not included in the PAT, then you don't have to deduct this or make this adjustment. The same is the treatment with the royalty income. Royalty income is assuming there's a non-operating, so you have to deduct that too. So CFO has been adjusted for non-cash items, non-operating expenses, non-operating incomes, and the changes in working capital. If you add all these items, you should get the CFO, and so CFO is 4432. So let us so PAT is 1414, and whereas the CFO is 4432. So the company's CFO is not same as PAT because in the PAT you have included many other non-operating, non-cash, and the changes in the working capital. You have received a huge amount of cash during the period from the debtors, and you purchased goods on credit, so therefore the CFO is much higher than the profit for the period. So this is another example to show that PAT is not same as CFO because of non-cash, because of non-operating, and because of the credit items, which are also called the changes in the working capital. Thank you very much.